Why do at-the-money options have the most extrinsic value? Imagine standing at a crossroads where your choice could lead to many different paths. That's what at-the-money options feel like in the world of options trading. When the strike price of an option is exactly or very close to the current price of the underlying asset, it's called at-the-money. Now, why do these options tend to have the highest extrinsic value? Let's break it down. Extrinsic value is the part of an option's price that's above its intrinsic value, which is the real, immediate profit if you exercise the option right now. Since at-the-money options usually have little or no intrinsic value, because the strike price is equal to the current price, most of their premium is made up of extrinsic value. This extrinsic part depends mainly on two things: how much time is left until expiration and how volatile the market expects the underlying asset to be. Think of it like a bet on future movement. When an option is at the money, the underlying price is right at the strike, so there's an equal chance it could go into money or out of the money. This uncertainty makes the option more valuable because there's a higher chance it could become profitable before it expires. The longer the time until expiration, the more chances the underlying price has to move favorably. So, if an at-the-money option has several months left before expiration, it's more likely to swing into profit territory. This is why at-the-money options with more time remaining tend to have higher extrinsic value. Now, let's talk about volatility. When market volatility rises, the expected size of price swings increases. At-the-money options are most sensitive to these changes because their value is heavily influenced by the possibility of big moves. Higher volatility means a greater chance the underlying asset will move enough to make the option profitable, boosting the extrinsic value. On the other hand, options that are deep into money already have intrinsic value, which is the difference between the current price and the strike, so their extrinsic value is lower. Out-of-the-money options have no intrinsic value at all, so their entire premium is extrinsic, but because the chance of moving into the money is smaller, their extrinsic value tends to be lower than at-the-money options. In practical terms, traders pay the most for at-the-money options because they offer the best balance of risk and reward. They're often used when traders expect volatility or a directional move, since their extrinsic value is most responsive to these factors. As expiration gets closer, extrinsic value shrinks because there's less time for the underlying to move. Understanding why at-the-money options have the most extrinsic value helps traders pick the right contracts for their strategies, whether they want to bet on volatility or hedge against market moves.